XRP versus Bitcoin. Why settlement wins. For over a decade, Bitcoin has dominated headlines as the pioneer of cryptocurrency, the digital gold that launched a trillion-dollar industry. It was the first, the loudest, and the most recognized. Yet beneath the hype, Bitcoin carries limits that threaten its long-term role in global finance. Its slow speed, high energy use, and lack of scalability make it more of a speculative store of value than a practical payment system. Enter XRP. Created with a very different mission, XRP was designed not to replace gold or act as a hedge against inflation, but to solve the fundamental problem of money movement, settlement. Where Bitcoin confirms blocks every 10 minutes and often takes an hour or more for final settlement, XRP achieves settlement in seconds. Where Bitcoin consumes the power of small nations through proof-of-work mining, XRP uses an eco-friendly consensus model with negligible energy use. Where Bitcoin is capped at 7 transactions per second, XRP can scale into the thousands. This difference is not academic, it's existential. The future of global finance is not about holding digital gold in a vault. It's about moving trillions of dollars of value across borders, instantly with trust, liquidity, and compliance. In this world, the asset that wins is the one that can settle efficiently at scale. But it's not just about speed. XRP was designed as a bridge asset, a neutral currency that connects fiat, stablecoins, CBDCs, and tokenized assets. Bitcoin, despite its fame, lacks this interoperability. It sits outside the financial system, often seen as a challenge to governments rather than a tool for them. XRP, on the other hand, has spent over a decade building relationships with banks, regulators, and enterprises to position itself as the backbone of the Internet of Value. This documentary dives deep into the contrast between Bitcoin and XRP. We'll explore the origins of both assets, how Bitcoin became digital gold, and how XRP was engineered as a payment solution. The technology gap, proof of work versus consensus, speed, scalability, and energy use. The institutional view, why banks and governments lean toward XRP's utility over Bitcoin speculation. The role of regulation, adoption, and real-world pilots shaping their future. And finally, the big question, in the long arc of financial history, which asset survives as more than a speculative relic? Bitcoin had the first mover advantage, but history is clear. The first mover isn't always the long-term winner. MySpace gave way to Facebook. Yahoo gave way to Google. In the same way, Bitcoin may have been the spark, but XRP could be the engine that powers the financial system of tomorrow. This is the story of XRP versus Bitcoin, why settlement wins. Part 1. The origins of Bitcoin versus XRP. Every great financial shift begins with an idea. For Bitcoin, that idea was born in 2008 at the height of the global financial crisis. Banks were failing, trust in governments was collapsing, and a mysterious figure known as Satoshi Nakamoto released the Bitcoin white paper. Its vision was simple yet radical, a peer-to-peer electronic cash system that allowed people to transfer value without banks, governments, or middlemen. Bitcoin was rebellion coded into software, a decentralized form of money immune to inflationary printing and censorship. Bitcoin's launch in 2009 captured the imagination of technologists, libertarians, and investors alike. It became known as digital gold, scarce, decentralized, and outside the reach of central banks. Yet even in its earliest days, Bitcoin faced a problem: speed. With a block time of 10 minutes and settlement often requiring 6 confirmations, about an hour, it was clear Bitcoin was never going to function as an everyday payments system. It was revolutionary but limited. Fast forward a few years and a different vision emerged. In 2012, 3 technologists, David Schwartz, Jed McCaleb, and Arthur Brito, asked a new question. What if digital assets weren't just for speculation, but could actually power global finance? They saw the flaws in Bitcoin's design, its reliance on energy-hungry mining, its slow confirmation times, and its inability to scale. So they built something new, the XRP ledger. From the start, XRP had a fundamentally different mission. It wasn't created as a protest against banks, but as a tool for banks. It was designed to move money as fast as information moves across the internet, enabling near-instant settlement across borders. Where Bitcoin had positioned itself as digital gold, XRP was envisioned as the bridge currency for a new financial system This difference in origins shaped the trajectory of both assets. Bitcoin attracted miners, speculators, and those seeking a hedge against inflation. XRP attracted banks, payment providers, and enterprises looking for efficiency. One was about opting out of the financial system. The other was about upgrading it. Yet both carried symbolism. Bitcoin symbolized distrust, a way to hold money outside the system. XRP symbolized transformation, a way to modernize the system from within. These narratives continue to shape how institutions, regulators, and the public view both assets today. As the years progressed, Bitcoin leaned further into its role as a store of value. Its community embraced the digital gold narrative, even as scalability debates raged and forks like Bitcoin Cash tried, and failed, to reposition it as a payment tool. XRP, meanwhile, doubled down on real-world adoption, with Ripple forging partnerships with banks and governments, piloting cross-border payment systems, and positioning XRP as the liquidity solution for the Internet of Value. The contrast could not be clearer. One asset born in rebellion, the other born in collaboration. One designed to sit outside the financial system, the other designed to connect it. In the next chapter, we'll explore the technological differences between Bitcoin and XRP, proof of work versus consensus, speed versus scalability, energy use versus efficiency, and why these design choices could determine which asset ultimately wins the future.
Part 2. The Technology Gap. The clearest difference between Bitcoin and XRP lies not in their price charts or communities, but in their technology. At the heart of this contrast are two very different approaches to consensus: Bitcoin's proof-of-work mining versus XRP's consensus protocol. Bitcoin's proof-of-work was revolutionary in 2009. By requiring miners to solve complex mathematical puzzles, the system ensured that no single party could control the network. But proof-of-work came with costs. Transactions are bundled into blocks every 10 minutes, with final settlement often requiring 6 confirmations, about an hour. This is tolerable for digital gold, but impractical for payments. Bitcoin also caps out at around 7 transactions per second. For comparison, Visa processes thousands. XRP took a different approach. The XRP ledger doesn't rely on mining. Instead, it uses a consensus mechanism where trusted validators agree on transactions every few seconds. The result: settlement in 3 to 5 seconds at a fraction of a penny per transaction. And the ledger can scale to over 1,500 transactions per second, rivaling traditional payment networks. Energy use is another stark difference. Bitcoin's mining consumes as much energy as small nations, a growing concern in a world moving toward ESG standards and carbon accountability. The XRP ledger, by contrast, consumes negligible energy, making it one of the most eco-friendly blockchains in operation. This green profile aligns XRP with governments, banks, and enterprises that face mounting pressure to prove sustainability. Scalability also matters. Bitcoin's block size debates in 2017 exposed how difficult it is for the Bitcoin community to adapt. Attempts to increase throughput resulted in forks like Bitcoin Cash, dividing the community and confusing adoption. XRP's design, meanwhile, was built for speed and scalability from the start, with no reliance on miners or block size increases. Beyond speed and energy, interoperability is the game changer. Bitcoin was designed to be self-contained, a decentralized alternative to fiat. XRP was designed to connect fiat, stablecoins, CBDCs, and tokenized assets. Its built-in decentralized exchange, DEX, allows assets to be traded natively, and XRP serves as the neutral settlement currency between them. In other words, XRP isn't just a payment token, it's infrastructure. Critics argue that Bitcoin's proof-of-work makes it more decentralized and censorship-resistant than XRP. That's true in a narrow sense. Bitcoin is harder to change, but that rigidity also limits innovation. XRP's consensus model, while involving trusted validators, enables far greater efficiency and adaptability. For banks and governments, efficiency, compliance, and sustainability matter more than ideological purity. This technology gap has profound implications. Bitcoin's design cements its role as digital gold, a slow, scarce store of value. XRP's design positions it as digital plumbing, fast, efficient, and built for interoperability. In a tokenized world where assets move across borders and markets in seconds, infrastructure may matter more than gold. The next chapter explores the institutional perspective, how banks, governments, and enterprises view Bitcoin versus XRP, and why many are leaning toward utility over speculation.
Part 3. The institutional view. The real test of any financial asset isn't just how retail investors treat it, but how institutions, the banks, governments, and asset managers that control trillions, view and adopt it. And here the divergence between Bitcoin and XRP becomes stark. From the start, Bitcoin was embraced as an alternative to the financial system. Its narrative of digital gold, censorship resistance, and inflation hedging appealed to individuals seeking independence from banks or governments. But that same narrative has made institutions cautious. Regulators often view Bitcoin as speculative, volatile, and risky. Banks see it as a competitor rather than a tool. Even as ETFs launch and institutions allocate small percentages of portfolios, Bitcoin is rarely seen as infrastructure. It is treated as a commodity, a hedge, or a speculative asset, not the foundation of finance. XRP, by contrast, was engineered for institutional use. Ripple, the company behind its primary ecosystem, built partnerships with over 300 financial institutions worldwide, from Santander to SBI Holdings. RippleNet, its global payments network, has piloted cross-border transfers using XRP as the bridge asset. While Bitcoin sought to disrupt banks, Ripple worked with them. This difference in strategy is why XRP is increasingly seen not as a speculative alternative, but as a practical solution. Governments and central banks also view the two assets differently. Bitcoin is often associated with tax evasion, ransomware, and speculative bubbles. Its energy footprint draws criticism from policymakers pushing for sustainability. XRP, meanwhile, aligns with regulatory trends. Its low energy use, speed, and compliance-ready design make it a candidate for integration with CBDCs, stablecoins, and tokenized assets. Ripple has even worked directly with central banks on pilot projects. Institutional adoption is also tied to liquidity. Bitcoin has deep liquidity thanks to its popularity, but that liquidity is mostly speculative, traders buying and selling for profit. XRP's liquidity by design is tied to utility. Every transaction using XRP in cross-border payments or tokenized markets creates real demand. As adoption scales, this demand becomes structural rather than speculative. Of course, XRP faces its own challenges. The long-running SEC lawsuit cast a shadow over its adoption in the United States, even as it thrived abroad. But the eventual resolution gave Ripple clarity that Bitcoin lacks. XRP is not a security, but a digital asset with defined use cases. That clarity gives institutions confidence to engage with XRP in ways they cannot, with assets facing regulatory uncertainty. When BlackRock's Larry Fink talks about tokenization as the future of markets, he isn't describing Bitcoin. He's describing infrastructure that looks much closer to the XRPL. When Citi projects $100 trillion in tokenized assets, they are not imagining those assets settling on proof-of-work chains. They're envisioning efficient, compliant, scalable networks like XRP. For institutions, the calculus is simple. Bitcoin may remain a store of value, but XRP offers utility at scale. One is a hedge, the other is a bridge. And in the eyes of banks, governments, and enterprises, bridges matter more than vaults. The next chapter explores the role of regulation and adoption, how compliance, legal clarity, and government involvement could decide whether Bitcoin stays digital gold or whether XRP becomes the backbone of the new financial system. Part 4, Regulation and Adoption. No conversation about the future of cryptocurrency can ignore regulation. Laws and policies shape the destiny of digital assets just as much as technology or adoption. And here, Bitcoin and XRP face very different realities. For Bitcoin, regulation has been both a blessing and a curse. On the one hand, it has been recognized as a commodity in the United States, giving it clarity as digital gold. On the other hand, governments remain uneasy. Bitcoin is often linked to money laundering, ransomware, and tax evasion. Its volatility makes it risky for widespread institutional adoption. Policymakers tolerate it as an asset class but rarely embrace it as infrastructure. ETFs and custodial products have opened the door for Wall Street. But most governments view Bitcoin as something to monitor, not integrate. XRP's journey has been more turbulent, but potentially more rewarding. The SEC's lawsuit against Ripple cast doubt for years, freezing adoption in the US while international corridors continued to thrive. Yet when Judge Torres ruled that XRP itself was not a security, it gave Ripple and XRP a clarity that few digital assets enjoy. That ruling didn't just vindicate Ripple, it set the stage for XRP to be considered by regulators, banks, and enterprises as a legitimate tool in the global financial system. Regulatory clarity is key to adoption. Institutions will not risk billions on uncertain assets. Bitcoin may be too volatile and energy-intensive to gain compliance-based adoption. XRP, designed to meet the demands of banks and governments, aligns more closely with regulatory frameworks. Its eco-friendly profile fits ESG mandates. Its liquidity role dovetails with the goals of CBDCs and stablecoins. Ripple's direct engagement with regulators worldwide further boosts trust. Adoption flows from this clarity. Bitcoin adoption remains concentrated among retail investors, miners, and speculators. Its payment use cases have stalled. Even El Salvador's Bitcoin law has struggled with real-world implementation. XRP adoption, in contrast, is tied to RippleNet, ODL, on-demand liquidity, and tokenization pilots. Each of these involves institutions, not just individuals. That difference means XRP adoption is structural, not speculative. Yet adoption isn't just about institutions. It's also about retail. Here again, Bitcoin and XRP diverge. Bitcoin appeals as a hedge, something to buy and hold. XRP appeals as a tool, a way to send remittances cheaply, access tokenized markets, or connect with banks. Over time, as tokenization grows and CBDCs roll out, retail users may interact with XRP without even realizing it, embedded into the very fabric of financial systems. Of course, risks remain. Bitcoin could win by sheer brand recognition, cementing its role as digital gold. XRP must navigate global regulatory landscapes, integrate with traditional finance, and prove its scalability in real-world adoption. But the trend is clear. Governments and banks are far more likely to embrace an efficient, green, and compliant settlement asset than a slow, speculative store of value. The final chapter explores the long arc of history. Will Bitcoin remain digital gold, or will XRP emerge as the backbone of tokenized finance? Part 5. The long arc. Digital gold versus digital plumbing. History has a way of remembering pioneers, but it also has a way of favoring those who built systems that lasted. In the cryptocurrency story, Bitcoin will always be remembered as the spark. It proved that decentralized money could exist, survive, and thrive. It birthed an entire industry. But the question for the decades ahead is not who was first, it is who will endure. Bitcoin's legacy as digital gold is likely secure. Its scarcity, decentralization, and name recognition ensure it will remain a speculative store of value, a hedge against inflation, and a symbol of financial independence. But as global finance digitizes and tokenizes, Bitcoin's limitations become clearer. It is too slow for payments, too energy-intensive for ESG mandates, and too rigid for interoperability. Like gold itself, it may hold value, but it may not power the system of tomorrow. XRP, by contrast, was built for infrastructure. Its design is not about hoarding value, but about moving it. Where Bitcoin asks, how do we store wealth outside the system? XRP asks, how do we connect the system so value flows freely? That difference is monumental. The future of finance is not about vaults, it is about pipes. And XRP is engineered as the digital plumbing of a tokenized world. Think about the long arc of financial innovation. Gold powered early trade, but was eventually replaced by paper money backed by trust. Telegraphs revolutionized communication, but gave way to the internet. In each case, the pioneer paved the way, but the infrastructure that followed defined the future. Bitcoin may be remembered like gold, precious, scarce, symbolic. But XRP has the potential to be remembered like the internet, the rails on which value moves. Regulation, adoption, and institutional alignment will decide the outcome. If governments adopt CBDCs, tokenization expands to $100 trillion, and banks need a neutral settlement asset, XRP fits the bill. If the world continues to prioritize speculation over utility, Bitcoin may retain its dominance. But history favors efficiency. The world tends to adopt the systems that work, not just the ones that came first. In the end, it may not be a question of Bitcoin or XRP. Both could coexist. Bitcoin as digital gold, XRP as digital plumbing. But when future generations look back at the dawn of the Internet of Value, They may not ask which coin had the higher price chart. They may ask which one built the system that powers their daily lives. And on that measure, XRP has the stronger case. This is the story of XRP versus Bitcoin. Why settlement wins. The future chooses utility. Bitcoin will always be the pioneer, the first spark that proved digital money could exist. But the future won't be built on speculation alone. It will be built on settlement, speed, and interoperability. That's why XRP stands apart. Where Bitcoin stores value, XRP moves it. Where Bitcoin symbolizes independence, XRP enables connection. And in a world of tokenized assets, CBDCs, and instant payments, it's the bridge that matters most. The debate between Bitcoin and XRP isn't about which one had the bigger rally. It's about which one builds the financial system of tomorrow. Bitcoin may remain digital gold, but XRP has the chance to become the digital plumbing of a $100 trillion economy. If you want to keep exploring the untold stories shaping the Internet of Value, make sure you subscribe to LTL Productions. The shift is happening right now, and you won't want to miss the greatest transformation in financial history.